Wednesday, August 27th. I'm John Hutchinson along with Jeff Wood. We have a lot to cover with you this morning, so let's get into this really important day. It is, of course, NVIDIA earnings day, so keep your eyes out at the end of the day for that one. Some quick updates. I went over these Monday, but just in case anyone missed them, we will not have any live sessions this Friday, August 29th, or next Monday, September 1st, for the Labor Day holiday weekend. You will have trade alerts only on Friday. The market is open and operating. So if we have any additional trade closures or trade rolls, anything of that nature, we will make sure that you have alerts throughout the day. Breakfast Club will not broadcast next Monday, but we will return on Wednesday, September 3rd at our usual 8:30 time. And then, as I mentioned on Monday, Three Stock Strategy will return via email beginning Monday, September 8th. So just a couple of weeks away. As I said, big day. Everybody's holding their breath for NVIDIA, but there are a number of other companies reporting earnings between today and tomorrow, which I think you will want to pay attention to. Actually, I know you will, and I'll show you why. But it's not just NVIDIA. Today is between today and tomorrow, we have a number of tech-based companies between NVIDIA, CrowdStrike, Snowflake, Hewlett-Packard, Network Appliance, Dell, and Marvell Technology, all reporting either today or tomorrow. So a fairly broad spectrum of tech companies from hardware to software to obviously chips and semiconductors, security, networking. So a pretty broad-based look at what's really happening across the breadth of the tech market. And then tomorrow is a very heavy retail day. And I'll show you why this one's important here in just a second as well. But we have Dollar General, Best Buy, Dick's Sporting Goods, Movado, Burlington Stores, Affirm. Affirm is a buy now, pay later fintech company. Ulta Cosmetics, Ulta Beauty, excuse me, and Gap. Not that anybody shops at the Gap anymore, but maybe they do. I don't, but maybe somebody else does. So
Oh,
why are
I will
those?
tell you, I don't mean to interrupt, but I will tell you, since it's the first week of school, I actually went to a mall, I know, but I'll tell you, that place was packed. So I don't know what is going on. I mean, just first week of school or whatever, getting back to school, but that place was packed.
It is back to school. It's the last 2 weeks are the heavy times for back to school. And off topic, but of humorous note, Liz and I were at the Up North Cabin the first half of August, and I kid you not, one of the main grocery stores in the small town there, a small town called Benzonia, which sounds like a psychoactive drug to me, but anyway, they had their Halloween displays out in early August. And I just think that's wrong. But anyway, you're right. It's back to school. So not only are we getting a read on summer consumer spending, we're getting a wide look or a wider look at what's happening with consumers and consumer spending and how they're spending their money. Uh, if we break consumers down into four categories, just being very simple about this, those categories are luxury, quality, value, and discount in that order. So on Thursday, the companies that are reporting fall into those categories like this. Under luxury, you have Movado, which is they do watches, for example. Ulta Beauty is luxury cosmetics. Quality, Dick's Sporting Goods, Best Buy, Gap. Value, Burlington Stores, and discount, Dollar General. So we will literally be reading the breadth of consumer spending from a handful or a hand-picked section of consumer discretionary stores. So between today and tomorrow, we're going to have some. I don't know how Wall Street will react to things, but um, all of the financial media is focused on Nvidia, and there are other companies that are reporting that give us a much broader perspective on what's taking place in the overall economy. And as Jeff said, if malls are packed and people are spending, then that should translate into forward quarters, and we should see that in the next quarter's earnings, hopefully. But what this will tell us is whether or not was there a consumer slowdown in the summer months. Uh, and we're going to get a pretty broad look at that. So on top of that, um, some reasons to root for Nvidia to beat earnings today. When we look at Nvidia's price action as a function of the S&P 500, Nvidia alone represents 2.3% of the year-to-date gain in the S&P 500. If you add in the other core AI Mag 7 stocks, they represent 5.5% or 55% of the year-to-date gains. So if something goes right with Nvidia's earnings, that should lift the market, and it should lift subsectors or other sectors of the market as well. Conversely, if Nvidia misses earnings, and I've heard some really crazy numbers thrown out there, like Nvidia reporting missing earnings revenue by $8 billion, and missing earnings by 50%. I don't buy that. But so beware, be careful out there. But the broader impact beyond Nvidia, all of this is related to the current AI craze, but this broader impact is on other sectors like semiconductors, software infrastructure, networking, utilities, construction. This is all the build out from physical plants, physical warehouses, physical data centers, all the way up through the chain of providing artificial intelligence services or software or programs. It's much more important than just a single stock, and it has greater impact than is really I'm seeing being discussed. So because I just wanted to prove that I'm a know-it-all, I figured I'd throw that in there for you. At any rate, but the other impact here is on forward earnings expectations for 2026, which is currently forecasting greater than 10% growth year over year from this year to next year. So next year's forward EPS is currently 299. And the primary driver behind that growth expectation is AI and its breadth of impact. So if Nvidia were to miss earnings, that is going to be the avalanche rolling down the hill. And you would see I would expect a fairly broad sell-off take shape across the major indices, and a lot of stocks that we know. So, like I said, these are reasons why we should be rooting for Nvidia to beat earnings today. And I don't actually believe we have any trades on with Nvidia at the moment, but maybe we will in just a little bit. We'll see. Um, let's pop out and give me a second to change my screen. I want to show you a couple of things that I'm watching as it relates to NVIDIA. So let's go over to FinViz. Let me make this a little bit bigger for you. This is a daily chart of NVIDIA. And what will be important here in just a minute is, hey, it's not purple today. This line right here, 170. We can see we had a gap up move. That gap filled here back in the early part of July. But this line, this 170 line, has largely acted as a support base here, a springboard back here when it first broke out. Didn't touch, but certainly stayed above that level, touched and bounced back here. Again, didn't touch, but is held up. So a really strong and important line right there at the 170 level on NVIDIA. But if we clear these, and if we go over to their detail, you'll recall on Monday I was talking about Palantir and how Palantir is substantially overvalued on forward EPS basis. Take a look at this. I can't do that. Okay, I can't draw. Never mind. 30.2 forward EPS for NVIDIA's earnings. A This year, EPS growth rate of 47%, here about the middle column. Next year, 37%, 5 years, 33%. Uh, all of that for a company that has forward EPS of 30 times future earnings. It can be argued that this stock is still undervalued, and I'll show you that it is in just a second. The trailing PE at 58 still doesn't feel high. Not when other companies are in the 1, 2, or 300 forward PE ratios. This is, it's still fairly valued. It's still maybe undervalued based on their earnings expectations. So there are more reasons to start paying attention to this company, whether it's as part of a portfolio, whether it's as a trading stock, even as an options trader. And we'll take a look at some ideas on that with a little bit of a lesson today here in just a minute with Jeff's help. So let's do one other thing here, and then we'll come back to the chart. So looking now at my stock analysis calculator. This is when I want to look at forward valuations from a fundamental perspective, just a straight up numbers perspective. What does a stock tell me? What does the price tell me? The earnings growth rates. What information can I get from those from that stock? So in this calculator, what I'm looking at here is I have current earnings for this year, and they are reporting their first quarter, if I remember correctly, their first quarter today. So 2025 current year earnings of $4.37, a forward growth rate of 37%, with a current price of 182 gives me a potential 5-year return of 375%. That's a 4x stock. And I mentioned that even with its current price to earnings ratio, the stock is, to me, undervalued. That what this is saying is this stock is trading at a discount of 27%. So the stock should be trading at a higher price than it currently is. And even when we look at the chart, it isn't as if the stock is down recently. It's recovered from a pullback, but it's still trading at a discount. A nominal 27% is a reasonable discount, and one of my favorite ranges. Love discount percentages between 20% and 40%. Always where I find my best stocks. So this fits. And even if I look out forward 1 to 2 years, I can see a potential price appreciation here between roughly $240 and $330. That's nearly double the current stock's price in the next 1 to 2 years. And of course, we know that Wall Street will pull those numbers forward, especially if and as NVIDIA beats or tops its earnings expectations. So with that, we'll go back to the old stock chart. And a couple of things to note here. Looking over in this section, roughly right here. So we can see 2025 earnings, roughly 50% growth. Next year's earnings, 37%. But then look at what happens in 27 and 28. A pretty substantial slowdown expected in earnings growth. Now, 12 to 16% is still above market, but for a major tech company, that would, if those numbers were to come true, that would spark or speak to a top, all right, a real big top in this company. So is there a life expectancy to trading this company? Possibly. I would argue that, somewhere in this range, your AI craze is going to, Dave has talked about this in the past, you get the bubble, right? This period here is going to be the backside of the craze curve. I just made that word up, right? That's the craze curve. Jeff, make a note of that. You can have that one. It's the craze curve. So, if this slowdown is going to happen, right, it's a couple of years out, but it's going to happen on the backside of that bubble curve. Meanwhile, these 2 years' earnings are still or would still qualify as being at or near the top. So there's still potential for growth in the stock. There's still potential for return from the stock's price. And there are even ways to trade this with some unique new ways to look at options. So I'm going to get Jeff's help here in just a minute, but I'm going to walk through my thought process and some alternate ways. I'm trying to switch back over to the presentation now, which is here. There we go. And one way to do this, and I'll go back and forth between here and the stock chart to show you this, what I'm thinking here and why I'm showing you it this way in just a second. But to begin with, a laddered put spread is essentially staking out three distinct price levels with, you can do this selling or buying options. We're focused here on selling. So three distinct price points or price levels, starting at a very strong support level. So I noted the 170 level. So we set that as effectively our top strike and then worked down. Now, one of the advantages to trading NVIDIA is it does come in 2.5 wide spread choices. So you can do a 2.5, you can do a 5, a 10, etc. But for a major tech company like that, that 2.5 can work to your advantage. Now, when you look at some of these numbers, they're going to be a little weird at first. But when I move these over to the chart in a second, you'll see the thought process, which is limiting your risk to the downside in periods of perhaps volatile markets, but in very short time frames. So what I did here was build out three separate spreads. These are 2.5 wides. I also did 5 wides, and I'll show you those on the next slide. But these all used Friday's expiration, the August 29th expiration. So these are 2-day trades where at the top spread, you're not going to retire on this, obviously, but roughly selling at $46 for a little over $200 in total capital. Buying to close for 10 cents for a net $36 on $200. It's almost 18% in 2 days. But that 170 right here, this 170 is more than 7% out of the money. So you have a good solid block of protection in terms of support in the stock. Doesn't mean it won't go down more or can't go down more, but you need as much probability in your favor as you can get. So that's why I started at the 170, and then what I simply did was I went down in roughly 2.5 point increments. So the 165, 162.5, and the 160, 157.5. So those were three separate put spreads, collecting three different premiums. The capital is a little bit different based on the net credit, initial net credit, but you can just, if you need to, just use 250, right? It's 2.5 wide, so $250 in capital per spread here. But what I'm looking at here is $73 on a little over $660 in total capital. That's a blended return of 11% in 2 days. I'm covering the equivalent of $13 below a major support line, $12.50, from 170 down to 157.50. And like I said, all of these are 2.5 wide, but these little numbers here may not seem great, except you have to remember that this is in 2 days, right? These aren't 30-day trades. These are trades where we get in, hopefully hit numbers, get out, and then move on and do something the next week. If we then take a look at the 5 wides, the 5 wide was essentially double these values. So a total of 154 on about $1,300 in capital here in the fourth bullet down. Again, starting at the 170 and just going 5 wide there. Then I split the strikes, 167, 162, and then I had to go down to the 160, 155. A reminder, the purpose behind a ladder, most people think about laddering up. I look at it as laddering down. And the reason, if I go back to the stock chart, is this. if we think of this 170 line as this is our primary line here, right? We're at 170 and we come down here to about 157.50, right? This is our box. This is that we're laddering down into an area where Nvidia really should not be trading unless they missed earnings. There's no reason for the stock to be trading down here. So by setting up a spread here, by setting up another roughly here and another one roughly down here, right, we are taking the highest probability of premiums working in our favor. If we were trading up here, we're trading into the teeth of the market, which I don't want necessarily because there's more risk to me. Secondly, let's clear this for 1 second. Starting at this 170 line, if Nvidia were to roll over and pressure the top strike, the top spread up here at the 170 level, whether it's 2.5 or 5 wide doesn't matter. I have time to adjust the other two spreads down here, whether that's closing them, rolling them down further in strikes, rolling them out in time. I have more flexibility because of the split in the laddering approach. I'm not collecting a huge amount of premium, but as you'll see, this approach, even done at small levels, can be profitable over the course of the year. And another thing to consider is, we'll call this the R2, risk reversal. Typically, even when we make recommendations, right, we're typically selling, for example, 5 contracts at whatever this particular spread is right here. One way that you can think through laddering is to reverse that risk. We'll say it's still 5 contracts and sell 1, 2, and 2. So 1 at the top, 2 in the middle, 2 at the bottom, at the lower rung. So what you're doing is you're putting your capital risk at the lowest end of the ladder while still allowing premium risk in the form of the higher premium to lift your overall return, right? If this were 10 contracts, I might do 2, 3, and 5, right? So if I'm pressured at the 170 level, right, 80% of my contracts in either of these constructions are well below that. And again, I have time to adjust the trade, roll the trade, even close the trade. But with 80% of my risk being below that top spread, I don't have to panic. I take a deep breath, look at my options, my choices, and what is the market doing? What is the stock doing? What is the market doing? What's the index doing? Any corollaries that are running in the background. So I have more ways to play throughout the breadth of the ladder to maintain my overall credit. So Jeff, while we're here, let me stop sharing. Actually, before
I thought you were just going to say with 8 contracts, you just convert it into shares and then you just get the shares at a discount. And, you just have to have 800
absolutely.
times $170, whatever that is, a couple hundred, over 100,000. Yeah.
Well, yeah, eight at 17, you're talking $120,000 if you have it, sure.
But then, then you're getting shares at like a 10% discount. So, not too bad.
Got lots of ways you have more ways to play that. Absolutely. So let me stop sharing. Actually, we'll come back to it in a second. Let me do this. Let me just finish off the yield PowerPoint because there's just a blanket here. So one of the things you've heard me say over time is that more trades is not always the right answer. One thing that you can look at doing is expanding your positions within a single trade at strikes with a higher probability of expiring worthless, those lower rungs on the ladder. And using that or approaching that with the shorter trading time frame, so between 2 and 5 days. And this can get you back towards that weekly income, weekly option approach. The benefit to this is over time, it can generate a higher return on capital simply because of the time function, the time in market function. So for example, that the 2.5 wide spread at $73, if, of course, if you could replicate that over a full year, that's almost $3,800 in cash on weekly capital of $750 at one contract. That's a 500% return on capital, right? And yet that's only $73 a week. So, and it's roughly the same if you're doing the 5 contracts, a little variance because we went from 1 to 5, but it's excuse me, the 5 wide went from 2.5 to 5 wide. Excuse me. But the key thing to think through here is just because an options recommendation comes out at a specific set of strikes for a spread, don't be afraid to look lower and to either balance your position risk with lower rungs on a ladder, um, or even expanding your contracts inside of that trading that particular position without we're not massively expanding our capital here with small strikes, whether it's 2.5 or 5 wide, we can still control that function because these small numbers, oddly enough, they can pay off. Whether it's 2.5 or 5 wide, I didn't go to 10 wide. It didn't feel like it was necessary. But even with initial premiums, excuse me, with net premiums ranging from 10 cents to 50 cents, the overall value on them can add up. And it doesn't take a lot of trades. You don't have to go to 20 or 30 or 50 contracts. You can 1, 2, 5, 10 max, and these numbers can pay off for you. So it's a different way to think through, even with an earnings call coming up, even with a stock that could be volatile following its earnings. There are still ways that you can leverage your spreads or single-sided puts. You can do the same approach with a single-sided put, be more expensive on the capital side, but the income return should be more because you're not balanced out with a buy side. But this laddering approach can be very powerful in if you're targeting options that and I didn't look at deltas here. I was just looking at the charts and I wanted to be below 170, and I just built 3 spreads from there that had a reasonable return in the cash side, on the cash side, and then put them together. That was it. That's all that I did. And you have now 3 mechanisms for generating income on the same stock, essentially within the same time frame, maybe a little faster here, but more ways that you can leverage your capital without having to expand out to more trades. So wanted to take a look at that, Jeff. If you have Thinkorswim ready to go, we'll build one of these out and take a look at what it might look like in real life. So let me
Sure,
stop
sure.
my side and hand it over to you. Oops, stop share and hand it over to you.
All right. Hey, there we go. That is, see if this works. Does that make it seem a little bit bigger? We can go to setup, application settings, look and feel. I thought I had this already. It says larger. Let's go to very large. Does that work? Does that make it better? Easier to read? I don't know. Doesn't look like it changed anything at all. Okay, so let's see. You wanted to start at 170, right?
Yep.
Or right. So if you're in Thinkorswim, just a quick keyboard shortcut. If you are interested, if you're on a PC, you hold down the control key. If you're on a Mac, you think you hold down that funky 4-cornered buttony thing. Anyway, left click on under the bid, since we're selling 170, hold down control key. You can know that you're holding down the right key when all these shortcut numbers show up at the top. Anyway, and then left click under the ask, and then you've built out your spread. So that's the 170 by 167. I'm going to go down to the 160, 165 by 162.50, and then the 160 by 157.50, right? Those are the 3.
That was it.
All right. Okay, so there we have 46, 27, 14. If we go to our risk profile, you have your ladder or stair stepper. If you're, yeah. And here's our current price. So a 10% move, I just kind of arbitrarily had the 10, that's the default in Thinkorswim, but there's a 10% move. So even if NVIDIA drops by 10%, you're looking at a loss of, if we go down and look at here, a loss on Friday. If you hold everything, drops 10%, you don't do anything, you're looking at a loss of $242. If it stays at current level, if it drops, I would say this is slightly more than half the distance. So whatever that is, let's say 6% or so, you get your full full $87. If it moves higher, you get your full $87, all that. So depending on if you want to manage the trade, it depends on if you just want to let it go until Friday and see what happens, whatever. Or if you say, okay, my stop loss is if the underlying makes a 10% move, whatever you want to do. If it is a 10% move, just as an example, your risk at that point then is about $257, unless it like gaps way down or whatever. Your risk is 257 for for a potential profit of 87. So there's your risk to reward ratio on a 10% move.
And we're still solidly out of the money. What's just out of curiosity, because I didn't look it up this way, what were the deltas on that working down roughly?
170 was your 20 delta, your 165 was your 12 delta, and your 160 is your 7 delta.
So roughly 10 to 20 delta range.
Yeah. Yep.
That was unintentional, but at least that can give folks
Sometimes
a
it works out
guideline.
that way. Yeah.
Yeah, for working through things. So something to put in your test accounts today to see how those would work out in 2 days, just as an example to learn how to do it or to get comfortable with it. You can modify the strikes. You can go 2 wide, 2.5 wide, 5 wide. It's completely up to you. Generally speaking, I think it's Rick who asked the question. Generally speaking, Rick, I would be doing that only on stocks that have substantial volume in the options realm. I'm not going to do that on a stock that has limited or low open interest or volume, because you're going to get a wider bid ask spread, have more difficulty getting the credit that you're targeting. So Mag 7 type stocks, Dow stocks, Apple, top of the S&P 500, top of the Nasdaq. The really your big stocks, your mega cap tech. That's what I would more or less limit that to, or indices. SPX, SPY. Actually, what was it, last year or the year before, Jeff, when we did the SPY hedge trade?
They
That
were
was
doing spies in
that was
2022, I
so.
think.
You can also do this the other way around. If you expect the market to pull back, you can build a laddered. You're on the buy side, but you can build a laddered put hedge a laddered put hedge to protect against a downturn in the market. But in this one, we were expecting the market to continue higher, or continue to move higher. So this is just a laddered put credit spread. But I would only limit it. I would limit it to big stocks. So if I'm scanning, I'm going to be looking for stocks that have substantial volume. 5 or 10 million shares traded daily, just as an estimate. I mean, I don't even, what does NVIDIA trade on a daily basis? Average trading volume, somewhere in here.
In the millions.
179 million. So yeah, that would qualify. I don't think it has to be 100 million, but more than 10 million probably for me would be a comfort zone. And the other thing is test to take some stocks that you like, and you don't have to put the trade on, but build a spread, watch it, and see what would have happened in 2 to 3 days. And I would only use this approach intra-week. This is obviously because of the dollar values on the credit side. These are not trades that I'm going to make that are going to take 2 or 3 or 5 weeks to close. The risk reward, well, number one, isn't worth it, and the return on capital would collapse dramatically. So these are approaches that I would take intra-week. If I'm looking for a trade on a Tuesday or a Wednesday, those would be ideal days. And using the current week's expiration, those would sort of be some ground rules. Um, but that was the general approach that I have on that. So
Can I can I give everyone else, do we have a few minutes, a minute or two?
go right ahead.
Okay, I don't know if this will help, but I wanted to share this with everyone if I could, but I need to also find Zoom controls so I can stop share and share a different screen. Uh, so hopefully this is the right one. Oh, it is the right one, but it's not highlighting around it. Anyway, this is from the OCC, which is the Options Clearing Corporation. If you are looking for something, so it's just OCC.com. And if you go down to the penny program, you can look for these it'll allow you to download a list either monthly, past 6 month, or annual. These are all the stocks that trade in penny increments. So if you're looking for stocks, just spoiler alert, there's about 400 that when you download, there's only about 400 tickers. So these are all, if you're really looking for high liquid stocks, I'm not saying that all of these would work for what John is talking about, but what I am saying is if you're looking for highly liquid options, I would start at least with a watch list from the OCC penny program, because it will tell you all of the options that will trade in 1 penny increments. Again, not all 1 penny increment options, are going to fit or are super liquid necessarily, but for the most part, if you're trading in penny increments on your options, then you're in the right place for liquid options. So just wanted to share that. And actually, I think I can drop this link in the chat. So there you go. All right, I'm done.
All right, that'll do it for Breakfast Club today. Ran a little bit over. Recording should be up here in about 5 to 7 minutes if you were late to the party. Other than that, we have Millionaires Trading Club at 11 a.m., Income Masters at 12:30. For anyone still following the Income Madness week, we still have a few open trades remaining, and I think we closed 2 or 3 yesterday. So we're knocking them out one at a time, and that's it. That is a deeper way to look at earnings for the next 2 days, and some trade approaches, and a new idea for leveraging options for you. And we'll see you again next Wednesday. So a reminder: closed on dark on Friday, dark on Monday, and then all live tradings kicks off again next Tuesday, and then Breakfast Club. We'll be back with you next Wednesday morning at 8:30. So for Jeff and for me and for everybody here at Traders Reserve, have a great and safe Labor Day holiday, and we will see you folks next week.